Hey, best ever listeners. Welcome to the best ever CRE show. This is Beyond Multifamily. I'm Amanda Cruz, joined with Ash Patel. What's up, Ash?
Amanda, good to have you. How are things going with you? What's new? What's exciting?
Oh, man, I feel like we're spending money left and right. Right now, we have a new grading for 10 grand I had to put in at this one house, all kinds of stuff. How about you?
Funny you say that. I've got a friend who is like a bazillionaire and he's literally broke and he wants to build multifamily just for cash flow. And for reference, this guy's worth over $100 million, right? But
What?
I sat with him and his accountant because we were doing an investment together. And his accountant said, look, this guy is very asset rich, very cash poor. And for the last couple of years, I've tried to stay really liquid for potential buying opportunities that should be on the horizon. And all of a sudden, I've got nothing. Like I'm broke, literally broke. But we've got two closings this week, and one of them we've been working on for about 4 months. It was down to the wire. So today we were told if we can get all the docs in by 1 p.m., we can have the buyers do a remote notary deal. Um, Both sides their side, the buyer side kept throwing in new hurdles. So we got everything resolved, but we didn't meet the 1 p.m. deadline. We're going to close tomorrow. So that'll replenish a couple $1 million into the bank account. So that'll be good. A couple other closings on the horizon. So I should be back in decent shape. But these guys did something dirty. I got to share this with you. Their money went hard. This is for a $7.4 million strip center that we're selling. Buyers are out of Columbus. Seem like they know what they're doing. They've got a fair number of properties under their belt. Well, when their money was going hard, there was no change in their tone whatsoever. They didn't scramble to ask us for, a handful of last minute things. They didn't worry about delaying due diligence or buying more time or none of that. But what's crazy is after their money went hard, they kept asking for additional documents all the way, like today was supposed to be the closing date, all the way up to last night. We've been working 12-hour days for the last 2 weeks. And again, up until this morning, they keep asking for new docs. Turns out they put a clause in their purchase and sale agreement that says, what? You're shaking your head. What are you guessing?
That the due diligence period never starts until you deliver all of the DD documents.
No, we do that, but there's typically an acceptance for that, right? So we're way beyond that. So that's
okay,
a normal.
Okay, so at least you knew that. All right.
That's a normal thing to do. These guys put in as part of the closing, we have to deliver estoppels in their form, using their form. Estoppels using their form. Now, for the best ever listeners that may not know what an estoppel is, it is basically a document that says, yes, the tenant fills it out and says, yes, this is my lease. Here are any and all addendums or renewals. I've been paying my rent on time, or here's the payments that I've paid late.
So what's wrong with this, Ash? We ask for those sometimes.
Yeah. But again, the buyer in their purchase and sale agreement, they wrote every tenant has to fill it out on their form. Now, national tenants do not fill out user estoppel forms. They have their own. So one of our national tenants was Dollar Tree. And they, this store is like in the top 80th percentile nationwide. There's nothing to worry about. And they're like, hey, Dollar Tree didn't use our form. We're like, guys, they're never going to use your form. Like, this is all they provide. And they're like, well, that's not good enough. So they were buying indefinite amount of time. So our attorney scrambles. We get a hold of Dollar Tree, which is notoriously difficult to do. And we get them to modify their estoppel to something that meets their needs. Now, that was done about a week ago. They've never accepted it, right? They're perfectly fine with it. the buyer, the attorney, they've hinted they're perfectly fine with it.
But they can walk away without any money hard at any point.
But they didn't acknowledge it in writing. So literally they can walk away at any point, which is dirty.
Yeah.
Like, look, we'll push limits. That's just dirty. Holding something so stupid and small over somebody.
It's funny, all these lawyer type clauses. I hate this type of stuff, right? It is not my wheelhouse. Good thing we have good lawyers, because this types of like playing legal wording games is so frustrating, because you just do things thinking, hey, we're all moving along here in good faith. And then, there's a reason lawyers get paid so much money.
Yeah. Part of me wants them to back out of this so we can litigate. And they know, if we go in front of a judge, judges can be like, hey, like, you guys have had a lot of national attendance. Have you dealt with estoppels? Yes. Have you ever gotten them to agree to signing a user submitted estoppel form? No. Well, why would you put that in your contract? And why would you hold up the sale because of that? That's some dirty shit right there.
I don't disagree with you, but I also don't know that you would even win in a legal battle, because that's just the document that you signed. But now you know what to look out for in
but this
future
would never go in
purchase and
front of a
sale
judge,
agreements.
right? We would just litigate it.
Right.
And at some point, somebody settles.
Yeah. But now you have one more thing to know to look out for
Another lawsuit.
In future.
Yeah.
Yeah.
Oh, sorry. Yeah. One more thing to look out. So again, this is why what we do is so fascinating. And there's a big barrier to entry, is because every deal is so different, right? Every PSA is different. Every lease is different. So yeah. All right. Who are we interviewing today? Oh, Sarah Miskelly.
Yeah.
You
so
met her
Sarah,
at the Best Ever, right?
Oh, okay. Yes. Yeah. She's a fund manager. She actually lives in Costa Rica. So that's pretty cool. She's living her best life, and she places money into private real estate opportunities on behalf of accredited investors as a fund manager. And she has her own small real estate portfolio. She's mostly moved to passive investing over the past few years.
Yeah, I met her at the Best Ever 2 years ago. Fascinating young lady, really charismatic. So this should be fun. You ready?
Let's do it.
Let's rock.
Sarah Miskelly, thanks for joining us. How are you doing today?
I am amazing.
All right.
Sarah, good to see you again. We met 2 years in a row at the Best Ever conference. What's the latest that's going on with you?
Yeah, I mean, it's always a pleasure seeing you in person, and it's always a fun time. Latest with me is, right now we're in a very challenging market, and I think on my end, I'm always looking for good deals, and they're hard to find. So that's kind of where I'm at. But, there's always opportunity available if you're willing to do the work, right?
You've done a lot of multifamily fund to funds deals, right?
Yes, yes.
Have you done anything besides multifamily?
Yeah. So, my investors are really looking for diversification. And I think all of us are looking at the challenges in multifamily right now and seeing like, how can we also offer investors options, right? So I have some investors that are, getting into the energy space. So, oil and gas deals. And right now I'm actually doing due diligence on a nice triple net lease with medical offices. So, when times are challenging, you learn how to pivot.
We got to jump into that, Sarah. I mean, so I want to hear too how you came to be. I think, Ash, you know that story, but I don't, and the Best Ever listeners might not. And I also want to hear how in the world somebody's making a triple net deal work in a fund of funds model.
Yeah,
for sure. How you ended up in Costa Rica.
Yeah. All right. So I'll try and tackle all of those. So yeah, I mean, I'm very blessed. I grew up in real estate, right? So I think, when you kind of have that background, it's like there's knowledge that you think is just normal. And I really took it on and kind of made it my life. And, the ability to now do real estate as a fund manager from Costa Rica was largely driven by family priorities. I have 2 little kids. I'm expecting a third. And, I wanted a lifestyle where I can do what I love, which is real estate, help people access great deals. But also do it from a place where we have, a good lifestyle, pura vida, right? Beach after, grinding it out on calls and stuff. And then as a fund manager, one of our things is that industry itself has really become, I would say, more standardized. So how it works as a fund manager is, there's going to be sponsors that have a deal. They're looking for capital, right? And everybody's looking for capital right now. And as a fund manager, we're able to do due diligence on the deal, create a structure, using lawyers, et etc., where I'm essentially profiting from an upfront due diligence fee, but I'm also participating on that back end promote. So I'm very tied to the success of the deal alongside my investors. And I think that's what's really nice about the fund model is we're putting in a lot of work, also relying on that deal being successful.
All right, Sarah. So tell me about your background that got you to this point of being able to do due diligence on all these multifamily deals, some triple net deals. You said your family was in real estate. Did they have syndications and apartment buildings and stuff like that?
Yeah, so nothing as large scale as that. Like my family has a small multifamily portfolio in Toronto, Canada, where I'm originally from. So we're talking about, houses that are residential style, but that have our 5 or 6 units in them. And that's what I manage now as well. But from there, I guess I'm somewhat ambitious and I wanted to scale up and also get into a new market. So for me, the US has a lot more opportunity as a Canadian. And that's how I kind of looked at, okay, well, what is a way to do what I'm already doing, which is LP investing. I started out doing private lending deals when I was about 18 or 20, and then also get into kind of commercial assets. So I scaled up over time, and the best positioning for me with a background in sales and enjoying working with people was the fund management side of things. I'm not going to be, doing property management, even though that's my background, on an asset in Texas when I'm living in Costa Rica. So there was kind of steps in my journey to get from there to here. But it's been very exciting, and I love the ability to offer those opportunities to investors who real estate isn't their background, right?
I've got a lot to say. So, Amanda, I'm going to let you keep going because you know me.
All right. So we've jumped from small multi ownership to doing due diligence on a syndicator who's bringing a triple net deal.
Mm-hmm.
Fill in the gaps, Sarah. Tell me where your expertise came from on the commercial side.
Yes. So in terms of due diligence, that has gotten pretty tight at this point. Like when I started investing as an LP, like over 10 years ago at this point, I relied heavily on trust, right? So I was like, oh, you're referring somebody to me. You seem like a good person. If somebody seemed good and confident, I assumed the deal was solid, and I didn't vet track records. I didn't ask enough hard questions. And today it's the total opposite. So I pass on deals that look amazing on paper, a shiny deck, beautiful pictures. But if the data and underwriting and operating history doesn't hold up, my standard now is like, would I be comfortable putting my parents' money into the deal? So, trust doesn't replace due diligence, and that process can be multiple, layers. There's the actual underwriting of a deal. And I think in this day and age, we're all pretty lucky because you can do a lot now with AI and have it really support your due diligence process, and then actually get somebody who's skilled in, data and numbers to support you as well. But then there's also the additional side of things where you're looking at, well, what is a track record of a team? I do background checks. I do police reports. I have a PI that I do in
Hold on. What kind of police reports?
Yeah, you want to just know like what I know.
Osh, you're out. You're out.
And look, honestly, you know what? Like this isn't a witch hunt, right? Like it's more if somebody has traffic tickets, I have traffic tickets. Like let's be real, right? But is there anything that's a past business, a past bankruptcy, like losing investor capital? There's so many things that you kind of want to dig into now because it's very easy to repackage something and make it seem new when there may not be that underlying foundation that's critical to support that deal hopefully going well, right? We're always risk mitigating. This isn't ensuring perfection in a deal, but the more layers of due diligence you can do up front, you're better off, because I know what it's like to invest as an LP and have money tied up in litigation and, be waiting for return of capital and the stress of that. I don't want that for my LP investors. And like I said, I can't guarantee anything, but you can do a lot up front to make better decisions, essentially.
Sarah, on the due diligence side with the track record, I mean, everybody's track record looked great from 2015 through 2022. In fact, a lot of syndicators still, technically, their track records look great on paper because they haven't sold for losses, but they also haven't distributed in 2 years.
Or the bank hasn't foreclosed on their property.
But it's on it's on the way there.
Pretend and extend, right?
How do you get around those? How do you really uncover what's happening with a lot of these operators with deals currently in distress, but their websites don't show it?
That is a really great point. And I think it's one of the most critical points for LP investors right now is that, a track record over the last few years doesn't mean that much, right? I think I saw a LinkedIn post recently where somebody was saying investors in LP deals right now, they don't even know yet that their capital is gone, right? Like we're not at a
God.
point yet of seeing that happening. And there's a lot of sponsors now that are creatively structuring, pref equity funds that are really just capital calls in disguise. So with that, there's teams that I've raised on a deal, but I'm now stepping away and I'm like, let's see some more proof of concept before I put any more investor capital with one sponsorship group. So it's a really great question to be asking. And I would say for an investor now is like, look for track record before, the last few years where you were seeing those stratospheric returns. And when I was in real estate sales before and we were in a hot market, like everybody was making money, right? But it's when the times get tough, it really shows, what's coming out of the woodwork. And I would say you want to be very cautious with sponsors who don't have a track record beyond the last few years. And that's where diversification of asset classes, I'd say, is pretty important, and sponsorship teams.
Sarah, I love that you mentioned that the pref equity raises that they're doing. The multifamily people are great with marketing and spinning. A lot of the deals that they have now from a number of sponsors don't work with their 5-year hold, right? Prior to rates going up, everybody in multifamily, almost everybody in real estate returned investor capital well within 5 years. And the deals were done and they got great returns. Well, now even the biggest syndicators are learning that the deals that they're underwriting, they just don't work in a 5-year period. So what they're doing is more marketing nonsense. Oh, this is a generational fund. You can gift it to your kids. They have 10-year holds, right? Which is such bullshit because anybody can outrun a bad deal in 10 years in real estate. Over the next 10 years, prices are going to go up. So bad decisions can be masked. And once you have an investor committed to 10 years, you could do pause distributions. Listen, I already got them, right? And they don't have to disclose to the world that their deal is underwater or is a shitty deal to begin with. So the pref equity thing, I see a lot of that where, again, big and small syndicators alike are raising more money, but instead of just coming out and saying, hey guys, we screwed up, we need more money, investors, would you want to put more money in? No, they're saying, hey, we're doing another round of preferred equity. It's ahead of any other investor, and you guys get paid out first. Who wants in? It's such nonsense, right? Now, I've listened to other calls where they actually do cash calls with existing investors. And even those are spun where, one in particular, you have to put in, I think it was 50% of your original investment in order for you to get back a total of 40% of your total investment. So if you put $100,000 in initially, they need another 50. If they don't get these investors to put 50,000 more in, the deal's done today and you lose everything, right? Now, what they kind of buried was if you put the 50 in today, the best case scenario, rates go down, cap rates become more in your favor, market reacts positively. The best you're going to do is get 40% of your original and 40% of your pref. Not exact numbers, but around those numbers. So it's the dumbest thing ever. You're throwing good money after bad. But the alternative that a lot of novice investors struggle with is, do I tell my spouse, do I accept the loss that I lost $100,000 in this deal, or do I just keep funding it, right? Throwing money down a bottomless pit. It's a horrendous position that these syndicators are putting their investors in. Be honest, be upfront. Have you encountered any of these things?
You said that so well, and I think it's classic. Like,
Because it pisses me off.
yeah, it's like sunk cost fallacy, right? Like we always think, well, if we just keep going and you're putting extra cash into a bad deal, like I've seen all of it. And I'm very cautious now with, sponsors now they're asking me to raise for these funds. I'm just a hard no because I can see the writing on the wall that this is good money chasing bad. So I think the challenge is for an investor, not having enough education and kind of having been sold this dream of getting into multifamily and that it's so secure. I think that's the thing with real estate is I truly believe there is a lot of security in real estate. If, your loan to values aren't too high, et cetera, your DSCR isn't in a bad place. But essentially, I think LP investors, they think that there's more security in real estate and that nothing can go wrong. And that's the educational gap that I'm personally very committed to. And always being straight with an investor that there is risk to these deals, just like investing in a stock, just like buying a business. And once you know all the risks and you can maybe have, I like when sponsors give you kind of the different scenarios, right? So you're not just looking at an upside scenario, but you can also see, okay, if we don't hit this cap rate, if, XYZ happens, this is the downside scenario. Are you comfortable with that? I think that's really important moving forward is to put more emphasis on the downside scenarios. And then an investor can choose from a place of knowledge and that's powerful.
Sarah, you're the face for your investors, right? They're putting money into your fund. So they have a lot of trust in you. Have you had to be on the other end where you had to play middleman, middlewoman to deliver the bad news?
So I've done it when I was in kind of smaller deals in Canada where, there were some issues where actually one of these sponsors ended up being a fraudster. And I had to deliver news to an investor that, there's going to be delays to your capital. But what I personally did in that situation is I actually sold one of my assets to make sure that my investor was covered. So I've been in tough situations before. I'm not saying I'm going to do that for every deal moving forward, but having the ability to have hard conversations and also being accountable. I think that's a big piece of it where, we're seeing a lot of lack of accountability these days, where, bad news may be delivered, but as you were saying, it can also be repackaged and made to seem shiny and new instead of just being straight about the situation. And also not only being straight, but looking at, okay, well, what is the XYZ thing that you're going to do to solve this problem?
Are most of your investors US based or Costa Rican?
Everybody's US based. So Costa Rica is a whole other market. I have our residential, we have our residential property there and we live there, but I don't really touch that market. I like to make things simple, which is US investors going into US deals.
Do your investors ever say, how does a girl that's Canadian living in Costa Rica rep US based deals?
Yes. And I always make a joke where I'm like, you're not sending money to Costa Rica, right? Like this is all SEC regulated. I think in the way the world is working now is obviously I travel a lot. I'm flying to the US quite frequently, but at the end of the day, really with the way things are structured, no matter where you are, if you're putting in the work, you're putting in the due diligence. I've flown out to meet partners. I'm regularly at conferences. That's where I saw you, Ash. It's how much effort are you going to put in to ensure that you're taking the steps necessary to protect an investor. And, my investors haven't seemed to mind it. If anything, they love that I've been able to create this lifestyle for myself where I'm in real estate, but we've also been able to create that location freedom for our families. So I think they kind of admire it a little bit and it gets them more interested in, getting and working with me on the deals.
So any investor in any of my deals has an open invitation to my house. Do you do that? Like, can we go visit you in Costa Rica if we invest in your deals?
Oh, for sure. If you want to come surf or, Pura Vida, go to the beach, chill out. It's a beautiful place to be. And I do have investors actually that, ask me for recommendations on where to travel there and stuff. So.
Oh, I don't need recommendations. We're staying with you.
Yeah. Okay.
She's trying to pawn you off, Ash. She's trying to be kind, but also pawn you off at the same time.
I don't do good with reading between the lines. Here's another question. This is for both of you. Lately, I've heard a lot of people say, oh my God, so-and-so has three bad deals that aren't going well. They've paused prefs, cash calls, and they're still out doing more deals. What are your guys' thoughts on that?
I guess I'll go first. So it's double-sided, right? Like you kind of don't want to be working with somebody who shuts down when there's issues. Like there's just a character trait there where that doesn't really work, right? But you also would want to work with somebody who has learned from those mistakes and is doing things very differently with deals moving forward. So I would be more inclined to want to, work with somebody who acknowledges their mistakes and is going to move forward with a different strategy. But once again, it kind of brings us back to those pref equity funds, right? You have to be careful that it's not just a mask for something and a mask for a mistake. But I do think we all need to move forward when we have challenges in life and not, shrink into a hole and disappear and never pay anybody back.
Yeah, Sarah, I think you're hitting spot on there with the pref equity, right? What are they raising for right now? Some sponsors have sort of pivoted into debt funds or credit funds backed by something totally different, like the house flipping. I don't hate on that. I'll evaluate that on its own merit. I'm not trying to get into cash call deals from somebody whose deals are already going south, but I think there's something to be said about coming out and saying, hey, I have a couple deals that aren't going well right now, because not everybody's even doing that. And so at least they're being open and honest and saying, look, I made mistakes and here's where my deals are. Here's what I'm doing about it. And here's, the next opportunity and why I think it's good. And it's a fresh opportunity from scratch. I do see people, especially multifamily guys, who are coming in and trying to get deals in mobile home park space recently that don't make sense, but they're trying to chase yield. So I would be cautious right now about investors pivoting asset classes out of multifamily to anything, just because they're trying to move on and multifamily is not penciling.
Yeah. And by the way, shame on those people, because we've been screaming for 10 years that they should pivot out of multifamily. And no one even spoke to us at conferences, right? And now that multifamily's in the shitter, they all want to talk. So I agree with both of you in that, I understand the resentment from investors. Why is so-and-so out looking for new deals and raising for new deals if they have these that have gone bad? Well, I put myself in that in that syndicator's position. If we have a deal that went horrible, investors lost money, am I just going to hang up my hat and never pivot, don't do real estate anymore? No, it's for us, it's who we are, right?
And think about how much you learned from the deal that went bad that's going to make you such an better investor going forward.
Yeah, I love Sarah's point to that. And I too have invested a lot, not in real estate, but in a lot of other businesses where people had a history of failure. Those are the best, right? So I love that. You mentioned the pref equity funds that people are doing to recapitalize deals. Some of those opportunities don't look bad. Have you put any of your investors' capital in, Save My Deal pref equity fund?
So I haven't, but I do have offerings for my investors that are kind of in the private credit space. And that's because there is opportunity for deals that are looking for funding, but it's not necessarily because they're distressed, right? And I think that there's that big distinction that an investor from the outside may not see, that there are deals that still have a good, loan to value ratio. And they're just looking for access to cash because banks aren't as inclined to, lend on assets below 5 million, for example. So,
all right, hang on, Sarah. Let me ask the dumb question. If they aren't hurting, why do they need the money?
Yeah, for sure. So some of the deals, and that's a great question. Some of the deals, essentially, they just want to add some cash to, renovate them, improve the asset, but it's just it's easier to access cash from, and pay more for it, to be honest. And that's actually the benefit to an investor. Then go to the bank, and banks aren't lending anymore to kind of improve that asset. So it's not necessarily that they're in the shitter. Is that there's additional capital that can be utilized to kind of increase the value. And as we all know, in commercial real estate, it's going to be the NOI that increases the value on that asset. But this is the kind of questions that you are going to want to ask and get clear on when you are looking at any kind of fund structure that's asking for capital, right? Like, is this asset in distress? And that does come in by looking at the underwriting and getting a good, getting your eyeballs on that. Or is it just some capital that'll be utilized to make improvements or, accelerate the value of the property?
I'm glad you asked that, Amanda. I had that question in the back of my mind, but I thought I'd look stupid for asking it. So I'm glad you and I were thinking the
I'll be
same
the
thing.
dumb one. That's okay.
No, I was literally wondering the same thing. Sarah, you started out this interview with talking about a triple net medical deal that you're looking at. Can you give us the details on that?
Yeah, for sure. So, this space, it's actually a partner that I'm still doing my due diligence on, but they have a very large track record in the dental space. So it's actually dental offices in particular, and that's the niche and that's their focus. And their father was a dentist. They've built up, I think it was like $100 million business that they sold in the dental space. But when you look at that asset class, and like I said, I'm still doing due diligence on it, you're looking at something that isn't going anywhere. Like people need to go to the dentist, and you have kind of this triple net lease structure where a lot of the, expenses go on to the tenant. So it makes it easier to operate. And there's the ability to kind of, get invested in these deals. They're a package of assets, and they're also attractive right now to an exit to a REIT. So REITs are purchasing these. So it's a different kind of play. You're still going to get, your cash flow, but I think it's nice to say, okay, well, this structure has viability in this market versus, multifamily, which is challenged. And so is there an opportunity here to get access to a new asset class with somebody who's an expert in that particular asset class and scaling it? So that's kind of what I'm eyeing right now. And I have investors that are pretty excited about it because, once again, like you said, it isn't somebody going from multifamily and getting into mobile home parks. It's somebody who's always historically been in that space, and they're now scaling up their portfolio and giving that opportunity for people to partner on those deals.
Is this the real estate that holds dental offices, or is it the business as well?
Yeah, so it's the business and the real estate.
Oh, dang. Now you're going after a whole different thing
It's
here.
a whole
Okay.
different thing. Yeah, it's pretty interesting, right? So there's a lot of opportunities out there, and it's not always good opportunities, though. You really need to take the time to look it over and see if the numbers pencil out. But there's people doing some pretty great things out there if you can kind of get access to them, which is the whole point of the opportunity for LPs, right?
I'll tell you this story that happened to me not that long ago. I'm sure you're already thinking of this as you're doing your due diligence, but I had these private equity guys come to me not that long ago, and they want to gather some people together in the mobile home park space and then basically sell it off at some crazy multiple. What they failed to understand in their very basic analysis is that you can't just sell real estate for 20 times multiples, right? You can't just all of a sudden keep increasing the multiples as your NOI gets bigger and bigger. There is a bottom cap rate for real estate. How are you seeing these deals presented to you on, sort of the real estate business side, and what is their sort of exit plan that looks good?
Yeah, and that's a really great point to bring up. And that's where, as well, when you're looking at exit options, it's going back to, okay, well, there's that great option there that sounds really sexy, like selling to a REIT. But what's the alternative if that actually doesn't work? And that's where having multiple exit strategies is very important, whether that's in a multifamily where you're going to see people having a refinance strategy or what have you. But with this, it's like, okay, well, maybe it's going to get sold to a REIT, and that's going to be a really great, return for everybody. But the alternative is, are these assets still viable for sale to someone else, right? Whether that is a PE firm or another syndicator. So I think that's another due diligence piece for an investor, is not getting too excited about that stratospheric, equity multiple, and saying, well, am I still comfortable with this alternative where maybe my IRR is, like 18, 20%? Am I happy with that? And I think that's an important assessment from the front end for an investor to make.
And Sarah, what are your thoughts on the returns? Like when you're mixing real estate and business, I mean, you get the asset protection side of owning a hard asset, but you also take on that additional risk of the business side. What do you think the right sort of return metrics would be when you're now factoring a business versus just real estate?
Yeah, so I'm definitely not going to say I'm an expert in that right now. And that's where I'm doing my due diligence and learning. But that's where you want to make sure that whoever you're working with does actually understand what those numbers need to look like. And they understand the dynamics of underwriting that type of deal structure, right? Because underwriting a multifamily deal is going to be very different from underwriting like a medical space that actually has, for an example, an existing tenant in place in the triple net lease structure. So when you're going into new asset classes, a lot of work should be done up front, understanding it and getting with experts who aren't just, jumping into something else, like you said, that's new and they don't understand.
Sarah, I like this because it's real estate and business, right? A lot of fund managers are pivoting because, like you said, their constituents have had bad runs in multifamily. They're looking to diversify. The latest trend on social media is everybody buy business, everyone buy business. But what you're doing, I like it because you've got some real estate assets to fall back on. But now you can probably very easily portray a multifamily deal to your investors, right? You know that industry inside and out. I was thinking in the back of my mind, if you had a triple net deal, there's a bit of a learning curve for you to be able to talk that language to your investors. But couple that with a business that somebody's going to be running. How do you portray all of that to your investors?
Yeah, that's a great question. And this is kind of what I went through when I was bringing investors into the energy fund space, right? So the amount of work that maybe not every fund manager is doing, but any good fund manager, and I know a lot of really great fund managers, is we are treating this like a business, right? We're doing it full time. So the amount of effort that goes into understanding the asset class, whether that's books, interviews, podcasts, meeting people in person, you really want to understand something to the best of your ability, but then also being honest, like I am not ever going to represent to anybody that I am the number one energy expert in the world. I'm going to ensure that if an investor has a question that I do not know the exact answer to, they are getting a direct access to the expert in that field. And that's where we do as, LP investors and in this space, there is trust involved in understanding that you are going to have to rely on experts because that's why people invest as LPs. They're not trying to operate these deals on their own, but the learning curve and then representing that to investors through a lot of education, webinars, Q&A sessions, email chains. I send the longest emails that are like me and the CIO or CEO very transparently going through, 100 plus questions. So it gets pretty in depth to ensure that everybody is making an educated decision at the end of the day to pursue something or not. And you do not have to diversify if you don't want to. That's the biggest piece.
Yeah, one piece of advice I'll give you, because I've invested in a lot of businesses and some of them through private equity companies that should have known better, right?
Mm-hmm.
But they wanted the rip on the deals, so they moved forward with it. I would highly recommend getting a third party to really evaluate not just the business's current standing, but the outlook for the future and their business plan. It's going to cost you a lot of money to do that and a fair amount of time. But they do things like quality of earnings, right? They really dive into the books. Having that to fall back on with your investors, I think would be a great benefit. But again, it's a several month process
Yeah,
and the
that is.
business owner has to be okay with it.
No, and that is amazing advice. And as well, making sure that on some of these funds and stuff, like, are the financials audited? That's another piece as well. Like, there's the layers that we have to try and put in, even if there's a cost to it and some people aren't willing to pay that cost. It is so critical. So I love that, Ash. You're speaking my language.
Sarah,
Good.
it's interesting. Like you're going, from real estate. I know multifamily obviously has had the troubled few years, but then, medical office with a business, that's a little stretch. Then oil and gas is like its a whole other thing. Where do you see like your specialty?
Mm-hmm. So my background is hands down real estate. Like that's what I grew up in. So I would say the more real estate I can do and focus on, that's what I will always do. And then as well, it's like, okay, well, what are opportunities that I know there's experts in that field that I can also add in? But I would say at the end of the day, I'm not trying to do 10 things. And, my background and interest will always be in real estate, whether that's multifamily, because that's what I grew up, managing and running, or then some of these other structures that just have a logic to them. And I know Ash as well has been a big proponent of, getting out of the multifamily space. So there are a lot of opportunities that people don't even know about, right? And it's important to stick with it in my mind, real estate, but also making sure that you're adding some level of diversification for an investor to not be only in, for example, multifamily real estate.
Yeah, for the record, I'm not really anti multifamily as much as I am pro making money, pro high returns, right? And look, I invested in multifamily syndications all the way through to 2019. So it was great for tax write-offs and, decent returns. But there's just too many people that jumped in that bandwagon with blinders on and they don't know anything else and they refuse to pivot, which is stupid. But talk to me more about the oil and gas, because here's my perception, and it might be quite ignorant, but all the people that I've spoken with, it's almost like they joined Scientology or Amway. In the beginning of their oil and gas investment, they rave about it, and they can't wait to tell the world and bring on additional investors with them. But after some time, they don't talk about it anymore. And when I ask anybody who's exited, I ask them if they would do it again and if the returns hit their metrics. Answer's always been no. And I don't know enough about it. So this is an ignorant point of view, but I'd like to hear your opinion.
Yeah, no, I love that because it actually took me like 3 years of researching different oil and gas operators to even feel comfortable presenting something to my investors. And a lot of it has to do with, there's a lot of risk in that asset class. And I think right now people going into it, they need to be aware that yes, there's volatility, there's market volatility. As we can see right now, we're kind of at a low point, in the pricing, right? And what happens is the structures of the deals themselves can vary. So if you're going after like exploratory drilling, like wildcat drilling, for example, you're kind of going in saying, I hope we strike. And there's a lot of risk there. And then when investors are getting into the deals, they're not necessarily getting the returns they've been promised. And instead they're getting the tax benefits, which is also something that people go after in these deals. But the returns are just, like you said, they're not happening and people are not happy with it. And then there are some teams that are the one that I kind of went after was they're looking at it in a more diversified way. So they're buying producing assets, but they're also buying land to kind of expand operations. And they have a track record of success, right? So that's the pieces where it's kind of a diversification play in what you're putting the capital into. But you can also, once again, look at the track record of the previous funds and also get presented, okay, this is the upside scenario, but this is like the downside worst case scenario. And are you once again comfortable with that? So even within that space, there's different deal structures and risk mitigation. And I would say I'm definitely more inclined towards the one that is, diversified in and of itself. So it's a challenge for investors to kind of discern what is the structure that they want to go into. But I think knowing that there's different risks in terms of what you're investing in that space is very important to know, because then you don't want to end up like one of those investors you mentioned who's like, I wish I never did that, but we can't control the outcome, right?
Right now, West Texas crude has been at about $60 for a long time. We have uncertainty in the future of world economics. So I don't know that I would ever consider investing in it. I also met somebody at the Best Ever conference. He was a second generation oil and gas guy. And I asked him to kind of break it down to me and asked if there's opportunities in there. And he's like, no. He's like, all the opportunities occurred during the last generation. So he himself has shut down all his whatever businesses, pipelines, and he's gotten out of it because he said there's no future in it. So I would love to learn more. Any of our Best Ever listeners that are experts in this, please come on the show. Like, I'm really ignorant when it comes to oil and gas, but would love to find out more.
Hey, Sarah, you mentioned your investor pipeline. You have webinars, you do LinkedIn, all these emails. How do you get investors on board? What is the number one way?
Yeah, for sure. So it's definitely a lot of being engaging content. I post a lot of content. Like I'm pretty disciplined about creating that content. But the biggest thing is at the end of the day, with the more internet presence you have, having real one-on-one conversations that are lengthy, that understand what an investor is actually looking for, and not just trying to sell them one thing, but giving them kind of options about what fits in well with their portfolio. I would say that's very critical. So having a one-on-one conversation is the most important piece. And then from there, like following up with them and making sure that they know that their interests are, top priority, and that they'll essentially be, get deal flow and then get educated on those deals when they do become available as well.
I agree with that. That makes total sense. And what about to get to that point? You said you have a lot of content. What are you putting out there and where?
Yeah, so I'm a lover of LinkedIn. Ash sees me on there all the time. I'm on LinkedIn frequently, every day actually. And essentially I just, make sure that I'm, posting content that educates people on what it means to actually invest as an LP, what it is that a fund manager even does, and then giving them examples of, the risks associated with investing. I think people appreciate that, and not enough people do talk about that. This isn't, I would say my perspective isn't like bro marketing, like everything's great and you're going to make a bunch of money. It's like, this is what you should look out for. And then from there, investors will traditionally reach out to me, and then I could get very technical in terms of the technicalities of, DM conversations and the sales and marketing piece. But I would say that's the biggest thing is people they resonate with your story. But then they have to take the next step and actually know that you are a real person and have their best interests at heart when they do get on a one-on-one call with you.
And are you doing all of that yourself, or do you have people helping you reply to DMs and stuff like that?
Yeah, so I'm pretty engaged on my own in the DMs, but I also do have an assistant that does support me in terms of the engagement on LinkedIn, the profile views, connecting with those people, the, background campaigns and Sales Navigator. Like it's a whole ecosystem once you get into sales and marketing and LinkedIn. And it looks easy from the outside, but it's a lot of work, to be honest. But I definitely try and be as hands-on as I can, because it is your presence and your voice, right? That does matter there.
There are some shady players out there on LinkedIn that are huge, massive followings. And every one of my posts, they comment with the most generic chat GPT nonsense. And it's not that. Matter of fact, the one guy in particular was bragging how he has an entire team posting for him on LinkedIn and replying to other people's questions, posts, commenting on other people's posts. Why would you ever do that? Why would you say, hey, I'm as fake as it gets on LinkedIn, but I've grown to, 50,000 followers. So stupid. Unbelievable. So yes, be, like you said, have help, but be authentic, man. You
Yeah.
can't ever have somebody post as you or comment as you, in my opinion.
I love
Yeah.
the ones like you post something and then the replies are so obviously AI generated. It's like, and have you thought about networking with other investors as the solution to your problem? Like, no, I hadn't thought about that. Thank you.
Yeah, no,
Yeah.
it's funny. I'm honestly, like, I'm up sometimes 'cause I got little kids, right? So I'll get up at like 4 or 5 a.m. and I'll be working on my post, and then, get it out there. And I think, as we get more and more where everything becomes easier, actually being authentic is going to be a bigger selling feature. So being personally engaged, and it is a business decision, right? Like, how big do you want to get? And are you actually going to still be able to support running a good fund management business if you have like 100,000 followers or whatever that looks like? You have to be careful about, is it just chasing the clout of LinkedIn, or are you actually managing it like a business to just, create deeper relationships with the people that you are connecting with on there?
Sarah, is there an ideal time to post on LinkedIn?
Definitely in the morning. So, the earlier you can get in, the better, because I guess people are more engaged. So I'll try and get my posts out around, it depends if I'm in, Costa Rica, CST versus EST, but around like 7 a.m. Is really great to kind of just get the ball rolling.
We talked to Amy Silvis, good friend of all of ours, probably, and her theory was 9 to 11 a.m.
Okay, yeah, and
So, but listen, I don't know.
I
I don't
think
have the
she's in
right answer.
Pacific time. I do know her, yeah. So, and that's the challenge too, is like the time zone piece of it. So you kind of have to figure out whatever works for you. You know what I mean? But I would say mornings are
Yeah,
typically better.
I thought her theory came from, people get to work at 11. After the first hour, they're already done with work and they're surfing the internet, screwing around on LinkedIn. Sarah, you operate in a dirty, dirty business. There's a lot of players that are shady. How do you differentiate yourself? And I'll illustrate that. I never have been a big fan of capital raisers ever since I've had a run in with a few of them back in the day. And they're like, Ash, we want to invest in your deals. Like, yes, let's go. And then I find out, they charge 30% of the GP to bring their investor capital in. Okay, like let's keep the conversation going. But then they want to invest. They're literally ready to write a check without doing any background check on me. You mentioned all the police reports and background checks. They only cared about what rip they were going to make on the deal. Literally didn't ask me questions about me. The deal they probably barely understood because they were multifamily syndicators or cap raisers, and they're coming into our world. It was mind boggling that here you are publicly telling investors that you do all this due diligence, and here we are. You're ready to write multi-million dollar check with no discovery, no background check, nothing. So that kind of jaded me on capital raisers. I know there's some great ones out there. So how do you differentiate yourself from the people that are bringing down your industry?
Yeah. You know what I always love about you? How just like you're always like, yeah, soapbox. And it's true. Like we get such a bad rap. And it's funny when I was in real estate sales as a realtor, like everybody hates realtors, right? They're like, oh, you guys are commission breath, this and that. And it's like, but I knew so many people who were actually like very good at their job, and they were really helping people like find a home, and they would negotiate down, including myself, negotiate down like the price on the property to make sure it was the appropriate value compared to market comps and stuff. So at the end of the day, I don't think you can always know until you really get to know somebody, like what their level of internal integrity is. And, I think I was reading something the other day, and it's really understanding, okay, well, why is somebody doing it? Like what's in it for them? Right. And I think for me, I got into this because I had been an LP for so long, and I'd been in deals when I got started that went badly because I didn't do proper due diligence, and I felt the pain of that situation. And I got into fund management almost like from a place of, I don't want this to happen to other people. So I put so much emphasis on, the due diligence and really trying to educate investors on the risks associated with the deal. But I think for now, as the industry becomes more like streamlined and structured, I'm starting to see that there's more standardization to what it is that we're earning from like an upfront due diligence fee. We're not going into a GP, or at least I'm not going into the GP, not participating in the GP, just expecting to make some stratospheric amount of money. It's like, okay, who are operators that I know from other fund managers and from LPs? I actually asked my LPs who are in like 20 plus deals, like who is really performing right now? Like I'm always open to having those conversations. And then from there, ensuring that it's fair and equitable in terms of like what my earning ratio is. This is just my personal perspective, but like this is a long-term game. And if you start just chasing what sponsor is going to give you like the highest split, or, like just going after the money, like that is not going to end well for you when things don't perform. So like slow and steady, in my opinion, wins the race, and just maybe making less on a deal, but knowing that the deal really is, very, very solid. That's going to create longevity in this industry, because the reality is it's very easy to get a bad reputation, especially when you're online and presenting yourself daily. So avoiding that risk is something I'm trying to do. But I think as well, just putting more effort into going out and finding a sponsor versus the hundreds of sponsors that are asking me to raise for them, there's a lot of deals. I'm turning down deals frequently because I just don't feel comfortable with the team. But that's my personal way of operating. So I can't speak for
Look,
everybody, Ash.
good for you for trying to do things legally and ethically. But you know what I think would be a great service to our best ever listeners? Let's think of maybe 3 questions that they can ask their next fund manager that wants to pitch them a deal. So imagine you're a passive investor, very busy, but you just have 3 good questions that can trap one of these scumbags, right? So let's find, Amanda, you participate too. Let's all think of 3 questions that you can nail one of these people to the wall.
I love it. I'll go if you don't
All right.
mind. I would say, like, can you show me your due diligence? Like, you're getting paid a due diligence fee. Like, what did you actually do? And I would want to know what I would want to see, not just ask. I'd want to see their work of what they did.
I love that. So not the operator's due diligence, but you, fund manager, show me what due diligence you did. What questions did you ask them? Where do you have this? And if they can't produce it very quickly, they didn't do it.
Yep.
I love that. All right. What else? Here's one that I like. I hate when people say we're putting our own money into this deal too, when all they're doing is just putting fees into the deal. So how much, you said it yourself, like you've invested a lot as LPs. So I would want to know in detail how much money a fund manager has put in to other deals, including maybe the one they're asking you to put money in, and not just, I'm putting money in, I'm putting a big chunk in. I want a dollar amount, right? Is that fair?
I think it's fair. And if there's some deals I'm not putting capital into, like, for example, we bought a house in Costa Rica. My liquidity wasn't available at that time. We just bought it like an asset. I will tell my investors, I am not putting capital into this deal for XYZ reason. I'm not going to make it up. I'm not going to make up that I'm putting money into the deal. Like, not every single deal I'm putting money into, but I think that transparency is critical. And if they are putting money in, like you said, hopefully it's not just like fees or what have you. It's actually like liquid cash that they're co-investing with you.
And a good way to prove that is anybody who's put money into several deals has an Excel spreadsheet of all of their investments, right? So like I can produce that fairly quickly. I can take out the stuff that's not pertinent, but I can show a potential investor, hey, here's all the other investments that I've put money in. So also if they can't produce that very quickly, red flag, right? It just means they're putting other people's money into deals and not their own. I like that. And again, very quickly, you could probably produce that within 5 minutes.
Yep.
Yeah.
One other thing. So a lot of these big syndicators that are trying to attract any capital they can by fund to funds, they basically have a business in a box for you. So they'll even say, your money is not at risk. You have no risk until you raise enough. And then you pay your legal fees and then you can come in. So all you have to do is take this nice deck that I made you, put your face on it, and then just give it to everybody and raise the money. And so I want to understand, like, how are you actually at risk here? Like, do you have the legal structure already set up? Like, how much money have you raised? I want to understand how you're actually dedicated to this project versus a lot of these business in a boxes where they're literally going out to fund funds managers and saying, there's no risk to you. Just put all your investor capital at risk and you'll be in and make money.
And Amanda, they're lined up to put their face on these brochures.
Lined up.
Yeah.
Yeah. It's becoming a pretty big business. And I think that's like the challenge of the discernment, right? Is like, how do you kind of get through the noise of like good sales and marketing versus good underwriting or a good performing team? And that is a dynamic that I think will continue to be a challenge. But, I really try and kind of get more onto the side of let's look at the business, not just the sales and marketing. But it's hard when you kind of go into this space as an LP who's maybe not even invested in real estate before.
Yeah. And any of you fund managers that are dirty, you know who you are. You need to think about that. So, hey, listen, always fun hanging out with you. Look forward to the best ever, seeing you every year.
Yes.
You've done an amazing job with your life, your career. Love your posts. Best ever listeners, follow Sarah Miskelly on LinkedIn. She'll give you a roadmap on how to post. But
and how can best ever listeners get a hold of you, Sarah?
Oh, LinkedIn. Just send me a DM. I actually will
Obviously.
answer. I know. I'm like, that's the only place I exist. But I like to kind of double down on what works. So yeah,
Did
LinkedIn's
your
a great
mom get
way.
you on LinkedIn? Sarah, I tried to call you. You didn't pick up. I need to message you on LinkedIn.
What are you doing? Yeah, no, my mom's not on LinkedIn. I don't think she knows what it is.
Awesome. Sarah, thank you so much.
Yeah, so great to be here for both of you.
Thanks for joining us, Sarah. Best ever listeners, thanks for joining in today. If you enjoyed this episode, make sure you leave us a 5-star review and share it with somebody who could find it useful. Please follow, subscribe, and have a best ever day.